All right, well, we've got a nice crowd here. Andrew, you ready? I'm ready.
I'm ready. Let's do it.
And Alex, on the ones and twos, you ready?
Ready as always.
Okay, let's go.
All right. So this is just our title slide here. David and I are going to be chatting about the theme of how to raise money and how to pitch investors. The goal of this is to really help you as founders and you as people who have or will be pitching investors, whether it's your first concept, your third concept, your 10th location of the same concept, regardless, all of these issues are going to probably come up in just about any capital raise. So we're going to talk about not only what those issues are, right, but some strategy and some some insights into how to talk about these concepts with your investors, what you can concede, what you might not want to concede, and chat through any questions you have, and we'll try to keep this as collaborative and conversational as possible. So without further ado, Alex, let's move to the next one. This is our obligatory legal disclaimer. Everything we're going to be covering here is for informational purposes only. We're going to be speaking in very, very broad generalizations here, right? So, things we'll be saying broadly may pertain to most cases, but will not pertain to all cases. So with that said, this isn't legal advice. If you have questions about a circumstance that's specific to you, reach out to us, and then we can chat about your situation specifically. We're just kind of broadly and generally going to be talking about some of these concepts purely for educational purposes. So in other words, this is not legal advice in the sense that it would be if we were talking one-on-one on the phone.
Well, that's a much more thorough disclaimer than I usually give. I usually just say, this is not legal advice, blah, blah, blah. Next slide, but thank you.
I guess that works too, right?
No, I appreciate people like you in our law firm.
All right. So there are a number of themes we're going to talk about. We're going to dive right in and just talk about one of the threshold questions that comes up, right, when you're facing the idea of wanting to raise money for any reason, right? Whether it's to finance a new operation, whether it's to keep an existing operation alive, whether it's to subsidize growth of that operation, regardless, you're going to be confronted with the idea of how much do I need to raise? And to be honest, there's not a whole lot that can be done on the legal side until that question is answered. So what this means is that your financial advisor, your accountant, whoever's advising you on your business plan, projections, and financial needs should be one of the first people you talk to and involve in the capital raising process. You're going to want their help to create a budget, not only outlining how much money you need to raise, but how you'll spend that money and what return you can expect to earn on the money you're raising. You're going to need this regardless of how you plan to raise the money, whether it's debt, whether it's equity. These are all going to be questions you'll want to answer. So getting your financial professionals in the room early is going to be really key, and helping them understand not just what money you want to raise, but why is going to help make that conversation more productive.
Andrew, I was sitting around with some HL clients recently who have built out, I think between them, probably 30 or 40 spaces. And I asked the question of, when you create a budget, what do you put on the side for overage? How much do you think you're going to go over? And what's smart? And the numbers ranged anywhere from 20 to 50%. And these are experienced people. What are some things that people forget to put into their budget?
Yeah, I think the biggest one that we've seen recently, right, is the cost of raw goods like lumber, right, can go up very unexpectedly. A lot of what this is assuming you're raising money for a restaurant, right, or for a brick and mortar space. Your construction and build out budget is going to be the majority probably of what you're raising. You're going to want some working capital, right? There are labor costs, there are professional fees, but your build out budget is probably going to be the bulk of it. If the cost of goods increases unexpectedly based on market conditions, that can really swing a budget one way or another. And I think that it's not necessarily any one thing, but it's a product of the fact that these raises happen over a long period of time. Right? Often, these are rolling basis raises where it's not like you have 10 investors lined up and you sign all at the same time, you get the money all at once. Most of the time, you're structuring these deals to receive money in tranches, right? Or one at a time. Once an investor is ready to fund, ideally, they can sign a check and you can use that so that you can, sign leases and pay security deposits, right? And pay for fees as you go. Usually raises take 6 months to a year and a half to finish. And during the course of that period, costs and budgets can fluctuate wildly based on unexpected and unforeseeable market conditions shifting. Minimum wage could
You'll
go.
always raise more money than you think you need. The worst thing that you can do if you raise too much money is you have some extra money in the bank. And so what? So we give it back to the investors, or we hold on to it for something else that we need some improvements. Another thing that we've seen in budgets is that sometimes we don't know how long it's going to take for the build out. So we think once we've raised the money, the build out's going to take 3 to 5 months, but it ends up taking 6 to 10 or 6 to 12 because of supply chain problems, because of the fact that GCs seem to be overworked. It's very hard to find someone to come to the job, et cetera, et cetera. But go ahead.
Yep. No, you read my mind. I was going to say the general rule is worst case scenario, you raise too much money. You have money in the bank that you can distribute as a profit distribution. You come in under budget, you're a hero with investors. Worst case scenario is you underestimate the amount you need, and to get project kind of to the finish line and to get you open, you need to go to the very people that you secured already as investors and say, hey, we need to raise a little more money. That's an uncomfortable conversation because most of the time that will result in a dilution, either of your interests or of their interests or of everybody. So you don't want to dilute people right off the bat, because that puts a sour taste in the investor's mouth, and they're more likely now to scrutinize you throughout the course of the next year or two on your operation.
You got to set yourself up right. And frankly, if you can raise $1 million, you can raise 1.4 million. It's the same.
Right. Another thing to think about too on that point, I don't want to spend too long on this slide, but David, I think you're touching on something really important here. A lot of clients ask us, what if we raise 1.4 million, but we don't sell all of the equity reserved for that 1.4 million? What happens? The answer is that's up to you, and it's up to the terms of the operating agreement. But most of the time, you have a lot of options. You can keep that equity on the shelf for future capital needs. You can just terminate that equity and everybody dissolve that equity essentially, and everybody else's percentages equalize. It's not a big deal if you have more equity out there than you actually end up needing to sell. There's always an option to distribute that equity, to get rid of it in a way that benefits not just you, but everybody. It's a lot harder to be fully subscribed, right? And have a full company, a full house, and then say, ooh, we need to make room for more people. How do we do that? It's much easier to switch people than to spread the equity out.
Yep.
All right. Great. So most of this presentation, we're going to be talking about equity financing, right? The theme is how to pitch investors. An investor is someone who's investing money for equity. So that's what's called an equity financing. The alternative is a debt financing, which is essentially you taking on some kind of loan to meet immediate capital needs. We're going to talk really briefly just about the difference there and some advantages and disadvantages to both. But the focus of this webinar today is going to be on equity financing. Alex, whenever you were ready. Great. So debt financing is like I said, it's basically just taking on debt. Taking on a loan, you're borrowing money, you're paying it back over time, usually with interest. So loans, lines of credit, bonds, these are all examples of debt financing.
Who on earth can even get debt financing? I mean, if you're starting a restaurant, all I've ever seen in my career is that unless you own a house or a condo, or you have 3 or 4 businesses generating lots of cash, you don't even qualify for debt financing. Who on earth does?
Yeah, we're going to get into that. Debt financing is tough if you're going after bank loans, right, or institutional loans. Debt financing is possible if you have a rich friend or a rich family member who's saying, hey, I'll loan you some money with low interest and we'll do it that way as opposed to equity. There's sometimes an advantage to doing it that way versus equity. But to your point, David, those people are few and far between. Most of the time you're taking on debt, it comes with strings attached, which we'll talk about. And that's why in the hospitality world, particularly for bars and restaurants, and on the startup side of things, you're not going to have the assets under management necessary to secure a loan, at least not a large one. So that's why you see more equity financings than debt financings. But in the event you have an investor that says, hey, I'll float you a loan, how about that? we want you to understand kind of what the pros and cons of that situation would look like.
And I just want to point out one potential pitfall that I've seen 100 times. When you go to your local bank, this is really for first timers, and you say that you want to open up a restaurant and you meet with their SBA loan officer, they're going to rope you in and promise you everything. Oh, you absolutely will qualify for 250 to 750, la, la, la. They'll take you through the whole process. And then at the end, they'll say, you know, we're getting close. What kind of collateral do you have? And you say, what do you mean? What kind of collateral do I have? I'm an entrepreneur. I don't own anything. Oh, well, I'm so sorry. You don't qualify. And you've wasted 3 or 4 months and filled out 8,000 pieces of paper. So don't buy it when the banks tell you that they have SBA loans to give you. In almost every circumstance, it is a total lie.
Yeah. And that is actually a great segue into our next slide, Alex. So we're talking about, advantages and disadvantages of debt financing. Let's talk about disadvantages just for the sake of continuity right now. As David was saying, most of the time when you're dealing with banks, right, they understand, especially in the hospitality world, right, the success rate of hospitality business is pretty low. Success rate of any startup, pretty low. So if they're loaning money without any kind of guarantee or collateralization, they're just not going to do it, right, absent some kind of assurance that they can get repaid. And those assurances either come in the form of taking a security interest in your assets. So basically, if the company can't pay, great, we're going to seize control of all your furnitures, fixtures, and equipment, everything else. You don't see that too often because chances are the value of those assets are not going to be worth even half of the amount that you're taking on loan, especially with the depreciating value of those assets. The alternative is them saying, we'll take a personal guarantee on that loan, right? So if the company can't pay, we'll come after your personal house, we'll come after your personal assets. And that obviously comes with it a great degree of risk.
So we don't like personal guarantees on anything after COVID. We don't even like them on leases, even though we have to do it. But any place you cannot sign a personal guarantee, you should not.
Right. So, to David's point, a lot of times banks will, not necessarily advertise up front the fact that they're going to need assurances in the form of one or both of these things. And that'll be a term they'll spring on you halfway through negotiation. And you should go into those conversations knowing that that's going to be the expectation most of the time. Some larger companies can get away with it. If you have 20 locations of the same brand and you're hoping to get a loan to subsidize the 21st, it's a very different risk analysis, right, for the bank. They might say, all right, get your holding company here as a guarantor. We'll take a look at the corporate finances here, and that's enough. We don't need to come out of pocket because I'm looking at a bank account. It's pretty flush. You can pay this back, and we're confident in it. By the time you're there, though, chances are you can probably self-fund through corporate assets the future locations. So it's kind of a catch-22 there. Let's assume for a moment you're able to take a friends and family loan that doesn't require personal guarantees or security interest in your assets. There are still disadvantages to debt. One is that they come with interest that typically compounds over time. So the longer you need to repay that loan, the more you actually have to pay back in the aggregate. So it puts a clock on the repayment, and it incentivizes you to pay it back quickly during the first few formative years of your business, when profit's likely to be, small. Your margins are probably going to be thinnest the first few years, and yet you're going to be racing to pay back this debt.
All right, let's not waste too much time on debt financing, because not all of us have rich aunts and uncles.
Sure. Just to put a pin in the topic, the advantages are you're putting a ceiling on the amount you have to pay. That's the advantage, right? You know exactly what you have to pay. The terms are really clear. So it's nice once you repay it, wipe your hands, and you're not paying them back forever. Unlike an investment where you're bringing these people in on more or less a permanent basis, right? You could repay them 10 times their investment amount and continue to write them checks if the company is super successful and you have lots of locations over time. So that's an advantage to debt financing, but most of the time, debt financing is risky, particularly for a smaller business or an untested brand. So I think, Alex, we can skip through these next few, talk about equity financing. Equity financing is the theme of the discussion today. This is when you are taking on investors and selling them equity in the company, selling them a percentage of the company in exchange for ongoing profit returns. Maybe you're offering them some additional rights in the business as well, which we'll talk about. So examples, say you're raising 600K, you're selling 30% of the company to investors. So in exchange for getting that investor money, you're giving investors a permanent part of your business, and that'll come with some rights for them, so that they're getting, by default, 30% of the profits for the lifetime of the business. And we'll talk a little more about what those terms tend to look like. So Alex, let's go to the next slide here.
Well, let's talk about who is the ideal investor. If you could draw up on a piece of paper and you could write down all of the qualities that you would look for in just the ideal investor, whether or not they exist, doesn't matter. Can you explain to us who is that ideal investor? What do they look like?
Yeah, so some qualities of an ideal investor. I mean, needless to say, you want them to have deep pockets. In the context of the hospitality industry, you want them to, be rich enough that they don't need to see the investment back necessarily soon or at all, right? But you want them to be passionate enough about the industry that they're actually believing in the investment's value, not as a monetary proposition, right, but as a passion project for them. They want to be able to help you. They want to be able to, say, hey, I'm a co-owner of this awesome bar, this awesome club, this awesome restaurant in New York City. How great is that? That's the ideal investor that you want to go after, because you want somebody who's hands off, but is also passionate enough about it that they share your dreams and share your vision.
So hands off is fine, but we also do like if they have something to add to the company, whether it's connections, whether it's, I don't know, a finance background. And while I used to think that I wanted people, this ideal investor, to not care about their money, I've actually turned the corner. Now I do want them to care about their money, because if they care about their money, they're going to care about your money, and they're going to help you make money. So deep pockets are great. We want someone who can help us open up our next shop because they believe in us and they've invested in our first one. We don't want them bothering us on the creative side, but we probably don't mind if they're there to help us on the financial side.
Mm-hmm. Yeah, absolutely. We've seen a lot of our clients develop great relationships, particularly clients who are chefs, right, with regular customers that have come in, right? Whether they're customers that you've done private events for, private catering, or just if you own a restaurant, you have somebody who loves that restaurant, you develop a relationship with them. They're probably going to be chomping at the bit to help you with your next one, because now they have an emotional connection to you and to your concept, and they believe in you. So having a pre-existing relationship helps to build a sense of trust, right? So that you're already kind of starting the relationship halfway there, because you have that dynamic. They know you, they know, the kind of quality of concept you can create. So a lot of the investors that we see are either, friends and family who know you already, or they're customers, they're fans that you've built up over time. So on the equity financing side, just some advantages and disadvantages relative to debt. Advantages, the biggest one is the flexibility, right? When someone makes an investment in your company, they're taking a huge risk, because they're not getting paid a cent on that investment unless and until the concept is profitable. The number of times investors take roll the dice, gamble on a concept and never see their money back, it's pretty high, especially in hospitality. So it's good for the company, because God forbid the place needs to close and shut down before you pay off your investors. Too bad, so sad, right? We're going to have documentation in the form of subscription agreements that investors are signing, where they're basically acknowledging and accepting that risk. And that's an inevitable risk of anybody who invests. So you get to decide when and if you pay back those investors based on profits, which may or may not materialize. Unlike loans, right, where you can say, oh, I can't pay back this loan because the business isn't doing well. If you have a guarantee, if you have collateral there, the conversation isn't over. You can't just say, all right, I'm selling off to the side set, I'm trying something else. So that's one of the bigger advantages to taking on equity.
Let's also talk about, Andrew, I know we talked about what a great investor looks like. As I'm looking at disadvantages, to me, the worst investors are the ones who take their last $15,000 out of their bank account, and they're trying to strike it rich with you, and they come every day and they knock on your door every day and they tell you how much they don't like the aprons on the wait staff. Like that is a very typical investor. And that's what happens when you go out there and you sell, 25 units at $10,000 a pop. It is an absolute nightmare.
Yeah, I mean, the worst investor you could bring on is somebody who overestimates their value to the business, right? And think that because of their experience, their background, they know better than you how to run the space, right? So they're going to backseat drive. And I think David's onto something. In our experience, at least, it tends to be, if you have 10 investors, almost invariably, the investor with the lowest amount invested, with the lowest percentage, is probably going to be the most annoying. I don't know why there's tends to be just a psychology there. I think if you're a younger investor or an investor who's forking over maybe a larger percentage of their net worth, they're more likely to take an interest in the business. And that can take one of two forms. One, they could be helpful, or more likely they could be annoying and say, hey, why are you doing it this way? And second guessing you, even though they themselves most likely couldn't begin to run the operation better than you can. So you want to be careful who you bring on. And one of the, we'll talk about this in a future slide, but one of the key considerations when you're raising capital from investors is to try to keep the investor count as low as possible. The last thing you want is too many cooks in the kitchen, no pun intended, when it comes to investors. You don't want to have, a large number of K1s, a large number of questions you need to answer. Ideally, you have a few people who you know already, who you have a relationship with, who trust you, who are there to support you, but aren't there to commandeer your idea and concept.
Okay. We got that.
All righty, Alex, on to the next slide, please. So just talking about equity financing and the structure of it all, the first step here is starting with an equity investment term sheet. That provides a snapshot of the legal terms of the raise. This would accompany any financial materials you want to prepare, right? Like a business plan, projections, investment deck, but it's really important to start with a term sheet. The reason you do that is it consolidates in 3 to 4 pages, something that will eventually be a 30 to 50 page document in the form of an operating agreement. We'll go into what that is. But if your investors, your prospective investors, are aligned with you on the term sheet, that knocks out most of the important conversations that you may have to have later. We've seen clients run into trouble where, they're talking with friends and family and you talk a little bit of numbers and you think, oh, they're on the same page. Let's just get them some docs to sign. I want them to fund this week. And then you give them the 40, 50 page document, and all of a sudden they come back with a list of questions and concerns. It's almost as long as that initial document. You realize, wait a minute, we weren't on the same page at all. They want all these rights we can't give them. They have all these questions that should have already been answered. Starting with a term sheet adds an extra step, but in our experience tends to save a lot of time and a lot of headache.
It's not an extra step. It's a necessary step, because when you're out there with your business plan, and you're pitching investors, meaning you're selling, because we all sell as entrepreneurs, like it or not, you're a salesperson sometimes. And when you're out there selling and somebody says, yeah, I want to invest in your next place, you better be ready with that term sheet. You don't want to then go back to the drawing board and start putting a term sheet together, because you've got momentum. And everyone's going to want to see the term sheet. So what we tell our clients to do is go out there with a business plan, have the term sheet in your pocket. So if somebody says, I'm interested, you just slap that term sheet on the table and now you're talking.
Right. Once the equity investment term sheet, everybody agrees in principle, that also gives you a lot more leverage, right? As David was saying, if the investor tries to retrade on a term, you can say, listen, we gave you the term sheet. You didn't have questions about it. Every other investor is on board with this. We either need you to get with the program, or maybe we'll leave you behind in the raise. It gives you a little more leverage to make it so that no one investor can hold up the financing. Lets you test the waters a little bit and make sure that you have the critical mass of support that you need. So if you have one investor who's being a stick in the mud, you can say, listen, everybody else is on board. So this isn't a investors versus company thing. This is a you versus the rest of us kind of thing. And we can't accommodate your asks here. So once the equity investment term sheet's done, those terms are going to be memorialized in what's called an operating agreement. I'm just looking at the guest list here. I know a lot of people already have these. They're very familiar with them. But just to recap, the operating agreement has been called the Bible of the business, right? Anything that has to do with ownership or control, voting, profits, management fees, everything relating to the structure and dynamics of the business is governed by this operating agreement. It's a really, really important document. The nice thing about the equity investment term sheet is it creates a skeleton for the operating agreement.
The
Before-
operating agreement is something you will absolutely refer to many, many, many times during the lifetime of your business. It's not something that goes in a drawer. It's not something you never look at again. You will look at it time and time again. Oh, you've got a partner who's misbehaving? Look to the operating agreement. You have an investor asking you for something? Look to the operating agreement. On and on.
Yeah, it's definitely a really important document. That's why, again, starting with a term sheet, it's really helpful to make sure conceptually everybody's aligned. If you're in line on the equity investment term sheet, the operating agreement negotiations tends to be pretty breezy. So there are two things that you'll present to investors as a condition to them investing. One is the operating agreement. You'll need to present that to anybody who's taking equity in the company, regardless of whether they're an investor or not. And then what's called a subscription agreement. Subscription agreement is essentially an investor contract, right? Investors agreeing to invest X amount of money for Y percentage of a business. They're pretty boilerplate, but they're also extremely, extremely important. You don't want to skip this step. Some clients do. Most clients who do later come to regret it. Here's what they do. Basically, they'll do a number of things. One is they'll disclose some risks associated with the investment so that, God forbid, the investment doesn't work out for the investor, they can't sue you, right? You're making the investor acknowledge, hey, this is risky. I might not get a return on this. You're making the investor acknowledge, I have enough net worth that if I don't receive a return on this investment, I'm not going to be broke. I'm not going to sue you. I understand the risks. I consulted with my advisors. I'm good to go, right? Think of it as an insurance policy. Another important component of the subscription agreement is making sure that the raise itself qualifies for an exemption from registration with the federal government. We're going to get into that a little bit. I don't want to bore people here with securities lessons and lectures, but there are some compliance components to a subscription agreement that are really, really important. We're basically saying most of the time we're doing capital raises for bars and restaurants, that we are doing a friends and family round. And we'll talk about what that means. The subscription agreement will require reps from investors that help us check that box. Failure to check that box can be really expensive, really time consuming for the company. There are options we have to pursue different exemptions, but again, it's going to be more expensive. So a subscription agreement, in short, saves you money and creates an insurance policy for the company anytime you're taking on investors.
Yeah. I mean, I always describe a subscription agreement as this. You're crazy to invest in a restaurant. You're going to lose all your money. You're okay with that. That's really what it says. And so nobody really gets scared by that. Let's move on.
Yep. So some rules of the raise. For most small hospitality capital raises, our goal is going to be to qualify for the so-called friends and family exemption from governmental registration. We could talk for hours, again, like I said, about the nuances of securities law. That's not what we're going to do here. Just for purposes of this webinar, what's important to understand is that the general rule is that when a business is selling equity to investors, that equity and the raise itself either has to be registered with the Securities and Exchange Commission, unless you can find and qualify for an exemption to that general rule, right? One of the exemptions, and the exemptions we like to target, is the so-called friends and family exemption. That's appropriate for smaller capital raises taking place within a close circle of friends and family, right? Just as the name suggests. We like this exemption because it means you don't have to file registration or exemption paperwork with the SEC or state regulators. Everything's done via contract. It's faster, it's cheaper, it's better. Most 90% of hospitality raises proceed under this exemption, but there are some rules of the road we want to watch out for. There are a number of factors that determine whether this exemption is appropriate, but one of the most important factors is the investor count. The lower the number of investors you're bringing on, the more secure you are in relying on this. Try to stay within your close network. Try to avoid using third-party broker-dealers and bringing in outside parties. And to the extent you're talking to an investor, make sure you're talking to them directly. Have a close and interpersonal, personalized relationship with them. Make sure they have access to all the information that they need about this raise. Make sure they have a direct line to you if they have questions, right? You got to control the narrative and develop that personal relationship here. Perhaps most importantly, don't publicize the capital raise, right? If you're talking to investors, keep the conversations with investors limited to private channels. What does that mean? Don't post on social media about your capital raise. It can be very tempting. Say, hey, we're opening a new location. Any investors interested? Email me, right? Don't mention it on your website. The second you do either of those things under the eyes of the law, now your capital raise is a public offering, believe it or not, right? Now we have to register it as such and exempt it. And we can do that, but that is a huge time and cost burden. And something as simple as an accidental slip on one of those fronts can mean all of a sudden the raise becomes cost
Yeah,
prohibitive.
don't take your customer list and say, hey, we're looking to fund for a new place. Here's some of the terms. It's like the worst thing you can possibly do.
Right. So try to keep the investor count low. And to David's point from before, really think critically about who you want to invite, right? Think about what that investor profile is, because just because somebody's willing to invest doesn't mean that they're the right partner necessarily. So think about the profile of the people you're trying to target and try to be strategic in who you're soliciting. Again, I'm very grossly simplifying what is a complicated regulatory framework here, but these are just some general tips to try to stay within that friends and family category. 10 or fewer, that's the ideal number of investors. The more you have, the murkier this gets. Usually if you're above 20, we have to seek another exemption under the act. All right, let's move forward. So let's assume you know the amount that you need to raise in capital. The next question becomes, what percentage do I need to sell? Now, yes, this is going to depend on your company's valuation, right? There needs to be some kind of logical relationship between the valuation of the business and the percentage of equity that you're selling. But the percentage you're selling, in all honesty, it also depends on the investor confidence in you, right? An investor is going to be happier buying a 20% interest in a business operated by somebody with a proven track record than 30% in a business run by someone who's never run the concept before. So yes, it has to do with valuation, but it also has to do with investor confidence in their ability to recover their capital. So if you have a proven track record, if you can show historic profitability in other concepts or convince investors this investment is safer than others, that may move the needle here, right? Lean on your record, lean on your history, lean on your relationships. The more concepts you open successfully, the more leverage you'll have to determine what this percentage is going to be.
Yeah, this is everything. As you move forward in your career, as you start building concepts and stores that make money, your leverage goes up tremendously. You may start with your first project and have to do a 50-50 deal with your investor because who are you? You haven't proven anything. Nobody knows who you are as an operator. Maybe you're a chef, they know who you are, that's nice, but you haven't proven that you can make any money. You open up your first place though, and you make some money, all of a sudden that 50-50 deal becomes an 80-20 deal or a 70-30 deal on the next one. So you have to focus on making money on the first one, not just so you can pay your bills, but so when you go out there, your next place, because we're not opening one store anymore, we're opening up a hospitality group, you need to have that leverage to keep as much of that equity as possible.
Yep. I'd say, well, if we're taking, general averages here, if you're raising money for investors and that's your sole source of financing, you're generally selling between 20 and 40% of the business. As David was saying, it can be higher, it can sometimes even be lower, depending on where you kind of are in your career and how much money you need, what your leverage is versus investors. But usually we're in that 20 to 40% equity allocation here.
But what investors really care about, yes, they care about that percentage. We know what the street says, we know what the market will bear, but they're also going to be looking at your financials to decide and determine how quickly they can get paid back. Mm-hmm. And we'll talk about distributions and how that works coming up.
Yep. And on that note, yeah, let's talk about distribution. Oh. So as David was saying, one of the most important questions that an investor is going to ask is, how long does it take before I get my money back? Right? Investors, I don't know, David, I'm curious what your thoughts are on this. Generally speaking, right, they want to see a return in maybe 3 to 4 years of investing.
People want to see a return in 5 minutes, but right. It's not going to happen. 3 to 4 years, I would say, of our clients, let's say we've opened up 10,000 restaurants, I would say maybe 10% hit the 3 to 4 year mark of repaying their investors in full. Their projections say that they will, but guess what happens? The boiler breaks, there goes some money. Oh, something else broke down. I have to replace my stove. There's some more money. And so all of these things that we can't predict happen to us as we're operating our restaurants and bars. So even though our projections might say 3 to 4 years, if you can pay somebody back within 5, you're an all-star in my book.
Yep, absolutely. But that's generally going to be a question for investors, right? And in practice, projections have to be feasible. They have to be feasible. They have to be reasonable. A tool that founders have to simultaneously help investors get repaid quickly, right? So that your projections can reasonably, if you're saying 3 to 4 years, which is what investors like to see, to David's point, statistically, you're not going to hit that, but there has to be a feasible way to potentially do that, assuming everything goes right. A tool that founders have to both keep their equity percentages as high as possible, but also try to stay within that 3 to 5 year repayment period, is to offer investors something called preferred returns. And I know based on this guest list, a lot of you are comfortable and familiar with this concept already and have utilized it. But for those of you who don't know, what we're essentially saying with a preferred return is we're going to give investors as a group, right, as a class of members here, somewhere between 70 and 80% of their profits, sometimes up to 100, right? We can be flexible with that, until they recover their money, after which point they'll receive a percentage of equity equal to their equity percentage. So let's break down what this means. Let's say you're selling 30% of your business to investors. Instead of giving those investors 30% of profits moving forward, which would be the case by default, you're instead saying, we're going to give investors 90% of profits, right? To accelerate the rate that they recover their capital. Because if you're giving someone 30% of profits, that's not even a majority of the profit. You might need 9, 10 years to pay them back. Investors aren't going to be excited about that. But if you can give them 30% with an 80% preferred return on profits, you're taking that 9 to 10 years and you're cutting it and you're tripling the repayment rate without actually.
Don't have a heart attack.
Right.
Just because you're giving somebody 80% of the profits doesn't mean you're not going to be able to make money, because you're going to take your management fee or your salary off the top. You have to be able to eat and pay your rent and have a life. So that comes off the top. So if you need 125,000 as a base salary, you're going to get that before the preferred returns start.
Right. Exactly. And, I'd say most of the capital raises we see in hospitality have some kind of preferred return. I'd say actually 80 to 90% of them do. But to David's point, don't worry, they're actually mutually beneficial, because not only are you going to receive your management fee or your salary on the front end, right? So you're going to get guaranteed repayments regardless of profitability. But what you're essentially doing is you're retaining a larger percentage of the overall company than you otherwise would. Right? If you didn't offer a preferred return and investors were looking at your projections and saying, I'm only getting 30% of the profits for the lifetime of the business. No, I want more than that, because I'm looking at this and this is going to take me 9 years to recoup my capital. I'm not happy with that. You can say, we're offering you 30% of the business from an equity standpoint, but we're going to accelerate your payback. What that means is you retain more equity for yourself. The second you pay your investors back, now all of a sudden you as the founder or founders are getting the lion's share of the capital on the back end. Of the profits rather. So it actually it's a good thing for you in the long run, assuming the business works out. And if it doesn't
what I don't like is when our clients offer 100% of the profits. And I don't like it, because if you have you're busting your ass and you're having a good year, and at the end of the year, you've got your 125 and you have to pay out all of your investors and you get nothing extra, it doesn't feel so good. A little something for the effort is always welcome.
Mm-hmm. Yeah. I'd say what we typically see, the average deal would be you're selling, let's say 40% of the equity to investors, but you're offering them an 80% preferred return, right? What that means is 80% of the profits go to that 40% group until they recover 100% of their investment, after which point it's along equity lines thereafter. And to David's point, that other 20% goes to the founding class, right? So that you get at least a little bit of the profits on the front end, so that you can give yourself some bonuses, let's call them. That's not what they're technically called, but colloquially speaking, we can call them bonuses to reward yourself for the hard work on the front end. Because to David's point, the hardest couple of years tend to be those first few years getting the business off the ground.
Yep.
All right. So we talked about preferred returns, what that means and how to think about them. Let's talk about management fees now. Management fees are basically just salaries that founders pay themselves. They're not called salaries for tax reasons. If you own equity you own membership interest in an LLC, it's technically called management fees. But if you see the word management fees, you can think of them as salaries because practically speaking, they're basically equivalent. You want to not only set these, right, to make sure that you can pay yourself on the front end, particularly if you're offering preferred returns. So if you're offering preferred returns, you might get some profit share, but it's not going to be a whole lot compared to the investors. So you want to make sure you pay yourself a salary in the meantime. That's where management fees come in. You also want to disclose to investors in advance that these are going to be paid. Because if you don't, investors are going to look at the P&Ls at the end and say, wait a minute, I thought I was getting 100% of the profits or 90% or 80%, whatever deal you struck with them. Why is the founder getting money? I thought I was getting that money. And then you have to explain to them, oh, that's my salary. That's calculated and paid first. Disclose it in advance to avoid that conversation, avoid that confusion. Generally, investors understand that, right? If you're giving your full time and attention to a concept, of course you're going to get paid a salary. They're not going to dispute the fact that you're getting paid. They might dispute the amount though. So that's why it's important to get ahead of it and make sure that you're paying yourself fairly and that investors are on board with that on the front end. How do we recommend structuring management fees? It varies a lot, but what we like to do is we like to have it be the greater of two numbers. A certain percentage of gross revenues, usually it's 5%, could be higher or lower depending on how much time you're spending and how many hats you're wearing, or a certain guaranteed minimum. Why do we like to do that? Let's say, there are unexpected renovations you have to close. COVID was a great example of why you want the guaranteed minimum. If you're paying a salary that you need for your survival, right? For your rent, for your food, for you don't want that to be completely contingent on the revenues of the business if the business has to close temporarily or shut down temporarily. You want it to be the greater of two numbers to make sure that you get at least a guaranteed baseline there as a salary.
This is absolutely essential. And 150 should be the minimum, frankly, for anybody in this industry. You also need at least that much money to kind of live in New York City. I would also say that if you have a salary and you're not taking it, which we see happen a lot because cash flow maybe in the first 6 months is kind of light, you should be keeping track of what's owed to you because you will get that money. You can defer your salary and get it paid to you later.
Right. The management fee is described as a guaranteed payment. That's what you're entitled to collect. A lot of founders say, all right, I'm not going to pay myself this month, but I'll defer it, right, and pay myself. You have that option always, but you always want the option to take it if you need it, right? And it's saying to investors, look, we're simultaneously putting a floor and a ceiling on the management fees that you're paying so that investors know these fees aren't going to become runaway fees, but that you have the comfort knowing, all right, I'm regardless of how the business is doing, I know I'm at least going to be able to pay my bills.
And also remember when you start your hospitality group, which everybody should be doing, and you're taking management fees from 4 or 5 different places, it starts to add up. So if you have this setup and you own 4 places and you're taking 5% of the gross from each place, that's a pretty hefty salary. 150 from each place, also not bad. You can start to see the advantages of the holding company and management fees and how they end up finally making the operator some money.
Right. Exactly. All right. So moving on, let's talk about intellectual property for a moment here. So in my opinion, and in my experience, intellectual property is one of the most overlooked deal terms in an investor deal, but it's arguably one of the most important. So intellectual property, it's called IP for short. It's one of those legal terms that essentially stands for the brand of a restaurant. When you think of IP, think of brand. It includes your name, right, your trademark, even the look and feel of your restaurant. Trade secrets like recipes, menu design, operational techniques, everything that makes your concept distinct, right? And that other, that would cause a customer to look at that space, regardless of the sign on the door and say, I know that space, right? I know what that is.
The golden arches.
Exactly. Yep. but it's a combination of things. It's not just the logo, it's kind of everything. And the more successful you are, the more obviously valuable your brand becomes. So establishing the ownership, right, of this brand, which is an asset, and if you're successful, it could be perhaps your most valuable asset, is really important to do on the front end. It's kind of impossible to negotiate after the fact. So you really want to get ahead of this particular conversation with your investors and have this conversation on the front end. The reason being the ownership of the IP dictates how you can expand your brand, right? So let's say if investors share ownership in that IP, that means they're coming with you automatically in some way for every future branded location. Every
Not good.
deal
No.
you have with that, if the company owns the IP, right? So you got to make sure, if that's not the case, you get ahead of that early. We've seen a number of lawsuits over the years where people haven't had this conversation with investors, and investors get the idea in their head, right, that they own the brand and they have automatic entitlement in future expansions. That would be the case by default, unless you get ahead of it and disclose it very, very, very clearly.
Let's break this down a little bit. If you start a restaurant and you come up with the best name in the world, and it's the most successful restaurant, and then Vegas comes calling and Abu Dhabi comes calling, and they want you to do management agreements and license agreements with this unbelievable restaurant that you've started. If you don't own that IP, you have to either pay the company and your investors a fee to use it, or even worse, sometimes you have to ask permission. Hi, investors, can I please expand our amazing product? Well, yes and no. Maybe they let you, maybe they don't. Maybe they hold you up for a ransom. So owning that intellectual property is absolutely key. And if you can't own it outright, we have to make ways that allow you to expand it and expand it how you want. Remember, you're the operator. So this is the most important thing. If you don't currently own your IP, take a look at your operating agreement and maybe go back to the drawing board. Now, if you don't want to open up the same company and your plan for your hospitality group is to open different concepts with different names, not as much of a deal. Still a big deal, but not quite as big of a deal.
Yeah.
But you got to own that name, because these days there are so many ways to expand your portfolio, to put other things into the name of that restaurant and take all these opportunities around the country and around the world that can actually make you money and that can make you successful. And here is where you see the worst parts of people. Here's where you see the investors get greedy. So be really, really careful how you set it up, meaning own it if you can. Some investors just won't let you. I mean, they'll say, I will not invest with you. And we have ways of saying, okay, fine. If we want to expand, we'll give a kickback to the company in the form of a licensing fee or something else where you'll get a little taste of what I'm going to do to blow out this brand.
Right. But what we like to do is, regardless of where this conversation lands with your investors, right, regardless of whether the company and by extension the investors own the IP or whether the founders own the IP, we want the founders to have the flexibility to expand the brand. The question is, do investors have some kind of economic and automatic entitlement to participate in that future expansion? We're never going to put you in a situation, right, unless investors demand it as a deal breaker, and it's be a very unusual situation. But for the most part, I don't like to use the word never, but we never allow, investors to veto expansion opportunities, right? We're very careful to preserve that, because to David's point, the whole value of you investing in this brand is to maximize the upside. Right. So we want you to be able to grow this brand and expand it creatively in a way that you are going to be the best person to determine how to do that without having to worry about investors who are going to look at this purely through economic lenses.
Yeah.
So we'll make sure that you have the control. To David's point, though, this is a real sticking point for investors. And the difference is huge. You're telling the IP ownership conversation boils down to this for investors. Are you investing in one brick and mortar? That's it, right? There's something wrong with the lease and you lose that location. Doesn't matter whether you have 11 other profitable locations, they're out of luck. They're not getting a return on their investment. That's a hard pill for investors to swallow. Most of the time, investors aren't comfortable with it. We have to find some kind of workaround. The alternative is to say, investors, you're getting into the ground floor of a brand that's growing. There's virtually no ceiling on your investment. Come on in. That's going to make it easier to land investors. They're going to get excited and jazzed about that. So it's a really important term for investors. Investors sometimes don't even know to ask the question on the front end, right? And as David mentioned, this conversation and this dispute happens when you become the victim of your own success and you're opening locations 2, 3, and 4. That's when the fights start happening. So getting ahead of the conversation and establishing from the front end who owns this IP is important. One other thing I will say, know the answer to this before you create your deck, because we've seen lawsuits between founders and investors on this very issue where investors are saying, look at the deck he showed me. Look at the deck she prepared. They were talking about locations 2 through 8. Of course, I thought I'd participate in that expansion because that's what you sold me on. You sold me on the idea that I would get in on the ground floor, and now you're freezing me out of this expansion. That's unfair. And you know what? Investors are right in that case, right? Because you have a fiduciary duty to your investors, and you have a real duty of disclosure on the front end anytime you're selling investors on a concept. So
we're gonna
not including them, make it very clear. Our forms will have that in bolded letters, and we're really careful around this because this has become, particularly in recent years, really hotly contested idea, particularly in the hospitality world.
Well, it's going to be in the term sheet, and it's going to be, highlighted and with a neon highlighter. Like everyone's going to know about it, and you, as the salesperson, just need to know how to talk about it. And we can coach you how to talk about the IP, but you got to be familiar with what it means, because any kind of savvy investor is going to grill you on this stuff.
And as you're being grilled by these savvy investors, know that you have a couple tools in your toolkit here to try to get them to a reasonable compromise. If you feel strongly that you want to keep the brand and you don't want to share it, a middle ground that we're often successful in securing here is the idea of investors not having an automatic entitlement in future branded locations, but having a right of first offer to invest in them. So you're saying, listen, we know you're taking the biggest risk by investing in this concept on the front end. Hands down, they're taking the biggest risk. It's much easier to invest in a second or third location of a concept that has a proven track record. It's harder to invest in a concept that has 0. So investors have a point there. What you can tell them is, listen, we're not giving you automatic economic entitlement in future expansions, but we're going to come to you first. If we're opening our second location, we need funding. You have the right of first offer to invest on the same terms that we would go to a third party for, right? So before we can, go and open locations 2 through 4 with another group of investors, you're going to have an opportunity to match the deal we're offering to other parties.
It's a nice compromise.
Exactly.
Investors usually can swallow that pill, because if you are a runaway success on your first one, at least they have the opportunity to join you in the next one and to make some money. That's why they can handle it. And that's how you talk about it with them. There's another wrinkle in this, which is if you give them a right to invest in future locations and they refuse, let's just say you own a restaurant, it's a neighborhood spot and you're doing $4 million a year and it's running like gangbusters, and you want to open up a second one. And the guy's like, well, I don't really want to join you in the second one. So I'm out. We then end it. Like, you don't have to go back to that person for the third, fourth, or fifth one, because what we don't want are people waiting to see. Let's see what happens, and then maybe I'll join in on number 3.
Yeah,
so that's a little wrinkle also.
In a perfect world, there would be kind of a pay to play provision. Again, this is going to be hotly negotiated with your investors. We've seen deals made or broken on these terms. These are kind of make or break terms here. Keep in mind too, when you're negotiating, what is your business model? Is this QSR, and is it only going to work if you open 10 locations? If that's the case and you're raising money for it, you're going to have an uphill battle limiting investor ownership in the IP. I don't want to get too in the weeds, but a lot of you either have or are familiar with the idea of holding companies. If you're raising money in the holding company, it's kind of a foregone conclusion that you're opening expansions underneath that holding company. If you're planning to break the brand up or do things out on your own, you can, as long as you disclose it in advance and as long as it's in the documents that the investors are signing. So all this to say, think about it in advance, make sure it's in the term sheet, and disclosure is king here.
Good. That's
all right, moving on.
some hardcore IP talk there, Andrew.
Let's talk about voting rights. This is another big ticket item when it comes to investor negotiations. Ideally, perfect world, as a founder of a hospitality concept, you don't want to offer investors voting rights at all whatsoever, right? You tell investors you're investing on the basis of trust. They trust you. You know best. You've done this before. You'll be available to ask questions. They have economic rights, but you're making all the decisions. Whether or not you're successful in that depends on kind of your relationship with the investors, your track record, your leverage. Sometimes we've seen investors write very, very large checks with absolutely no voting rights whatsoever. It definitely can happen. More often than not, though, investors will expect some voting rights, and it's important to understand what this framework can look like. Investors having voting rights is not the end of the world. David and I were speaking earlier about the importance of you controlling day-to-day and creative control of the concept. That will and should always remain the case. But you can create a limited universe of major decisions that investors as a group might be able to veto. They don't have control over your budget. They shouldn't have control over your menu, over your operating hours, over your staff, over anything having to do with the actual operation of your space. But if you want to sell your business, maybe you have to get a certain number of your investors on board before that. You want to dilute your investors, maybe you need a certain number of them on board. So all this to say, a common compromise, right, in this tension between investors wanting to have a real seat at the table and you wanting them to be completely passive, is to say the default rule is investors don't have any voting rights at all. They can't get in our business and our grill. They're not going to backseat drive here. However, let's create a universe of very limited universe of categories of decisions that investors can veto. That's how most deals that we see are structured. And those major decisions are pretty nuclear, right? They're things that could either dissolve the company, discontinue the company, restructure the company, things that could negatively affect them. Amending the operating agreement is a very common one, right? Because without something like that, theoretically, contractually speaking, the second the raise is done, you could just amend the operating agreement unilaterally to get rid of their preferred return. You'd have some fiduciary issues, and legally you couldn't really do that. But having it in writing that they're not just going to have the deal suddenly changed on them gives investors a little bit of confidence and assurance that, okay, we can live with this.
They're all going to ask for the same shit. It's all like, if you sell the company, you got to ask and get permission if you're going to liquidate the company, and that's it. We don't give them anything else. Moving on.
But be careful how you structure that consent. We've seen a lot of forms out there, right? Particularly your off-the-shelf internet forms saying, if you have a major decision category, maybe you need unanimous consent of the members. Never, never, never offer unanimous consent if you have more than a small handful of members as a general rule, because that just gives investors so much leverage. Typically, how we structure that consent threshold is you take your managers, right? The people who are in charge, you say, a certain majority of them or every one of them is required to consent to any major decision, plus, let's say 50% of the investor class. That way you don't need everybody. You don't need all the investors on board. You just need a critical mass of them. And if I'm an investor, I'm okay. Because even if I disagree, I know somebody in the same seat as me has to consent, so it can't be totally unreasonable. So you want to avoid deadlock. You want to avoid unanimous consent. And you can think creatively about how you structure that consent threshold. That's really, really important. Most of the partnership litigations you see out there result from deadlock situations where the company doesn't know what to do, right? And you have one investor who's just refusing to accept the game plan, and then you get held up in court and you try to buy him out. It's a whole thing. So try to avoid that by structuring consent to be high enough to give investors confidence, but low enough to avoid deadlock and give any one investor too much leverage in any decision. All right. Disclosures and cooperation. This is a term that we wanted to include here because it's so important to put in operating agreements, particularly in hospitality. Anytime you're bringing people in to a restaurant, bar, hotel as investors, yes, the general rule is They give you money and they go away, right? You cut them a check every year for profit distributions. That's great. But there may come times where you need to get information from them, right? Or you need them to respond to a vote or something. You need to make sure that there is accountability for those investors, that they're not just going to disappear and never get back to you. Particularly on the licensing front, right? If the SLA asks for information from an investor and you ask the investor and they're nowhere to be found and you can't get back to the SLA, it's not a good look. That could jeopardize your license. That could result in a fine. Make sure that in your operating agreements and in your docs, we have language requiring their cooperation and their willingness to provide necessary disclosures to government authorities. It's really important, particularly in
We'll
hospitality.
take care of that for you.
And
Your lawyer should take care of that for you. You don't have to worry too much about that.
Yep. But I think the reason that this slide is included here, it's taken care of with, as David was saying, boilerplate language in your forms. But this is another reason why you want to pick your investors carefully, right? You want to make sure that they're going to be able to pick up the phone if and when you need them. Don't get somebody who's just going to cut a check and disappear. Make sure that you have an ongoing relationship with them. And to that end, pick and choose people who are not going to disappear on you and be available to respond when necessary. Very important when you have a closely held business.
Okay.
Yep. All right. Removal and buyout of investors. What happens when an investor isn't happy? You're not getting along with them. Can you buy them out? The general rule is buyouts in closely held companies have to be mutually agreed. It's very rare that you're going to see a right on either side to be bought out. You don't want investors to have them because then you could be, in a situation where the company's doing really well and then you get a notice out of nowhere from an investor saying, hey, buy me out at a multiple of my investment. You don't have that cash in the bank. Then what happens? Right? Generally,
you can't do that. That's not a thing.
You can't do that. But it works both ways. Generally, you can't force a buyout from the investors either. So if there's a disagreement, usually you have to work it out. But if they do something terrible, they start embezzling from the company. If they lied on SLA docs and they own a winery somewhere and didn't disclose it, and now your liquor license is in jeopardy, what can you do? That's where we come up with frameworks for involuntary removal. Basically lets you kick out investors or anybody who are bad actors. The reason I bring this up is sometimes investors are going to look at that and say, oh, I'm not comfortable with this. I'm investing. I want to make sure I'm in permanently. What we say to investors in those situations is the grounds for removal are so high. You literally have to commit a crime or to commit some kind of fraud or misrepresentation that rises to the level of potentially tanking the company for this to be triggered. I'm on the line with investors councils all the time that are saying, hey, why is this in here? I don't like this. And our response is always the same. Is your investor okay with all these reps? Yep, no problem. Great. What if a fellow investor lies, right? Do you want your client's distribution check going to a buyout to solve that situation and rewarding a bad actor who committed a crime or misrepresented something? The answer is no. So that's why, generally speaking, the interests are aligned here. And this is an insurance policy against bad acts. Just something to keep in mind. It's typically in our operating agreement forms. If investors react, that's the line of reasoning we usually take with them.
Good.
Yep. Moving on. Rewarding major investors. We get this question a lot, and this is why we have a slide for this. If you're raising money, let's say you're raising 500K, and you have one investor who's putting up 300 of that 500. I'm just using 500K as for the sake of easy math. 500K would be a low amount to raise if you're opening a bar restaurant in New York City. But let's just, for the sake of math, assume it's 500K and someone's coming in for 3/5. That investor may say, hey, I want some special terms. On the whole, you should keep terms the same for all investors, right? You generally don't want to do favors for one investor because then you get into trouble, right? You can have the other investor saying, well, I wasn't offered that opportunity. Maybe I would have invested 300K if I knew X, Y, and Z. You can't prove that wrong. They probably wouldn't have, but if they say, hey, I might have changed my mind and done something differently, you're still in trouble. So you want to keep all the investor terms the same with respect to everything that's going into the operating agreement. You don't want to play favorites, even on the basis of higher investment amounts. What you can do, though, and what sometimes people do is you say, listen, we're going to have a preferred investor informal group, right? Where if you invest a certain amount of money, maybe you'll have perks, not relative to the corporation or LLC, but relative to the restaurant itself. Maybe you get preferred reservations. Maybe we're going to comp a certain number of meals. maybe we're going to do certain things for you. We're going to give you priority reservations, guaranteed X, Y, and Z at the restaurant, bar, club, whatever it is. And if that's the case, then you can disclose it in the term sheet. You don't really have to worry. It becomes very dicey if you want to offer different legal terms to different investors, because you got to know who's coming in advance. And again, disclosure is key. So this is an option that you have if you want to say, listen, if you invest over a certain amount of money, you're getting certain perks relative to the restaurant, but try to resist the temptation to give people different voting rights, for example, or different preferred returns on the basis of how much they're investing, because that can kind of mess up the balance of things. And you got to know those things in advance when you're talking to investors.
Okay.
And I think that's it. Alex, do we have any more slides? No, we're up
Well
to Q&A.
done. Thank you, Andrew. So now we have time to answer some questions. So this is when I usually speak really slowly as people start typing. But please feel free to ask us any question you may have about investors raising money. We've seen it all, and we've seen them all from a $100,000 raise to a multi-million-dollar raise. So I'll give everybody a couple of seconds. Alex, do we have another webinar coming up? When's our next webinar?
We have a webinar in mid-April with Andrew Fine again, and also Lee Jacobs on payroll and management companies. So that's our next one coming up on the docket as of right now, but we always add more.
That's exciting. Payroll companies. All right. Now we're getting into it. Here's a question. How do you determine future company value?
That is a great question. There's no concrete, easy answer to that. I would say part of the reason why you get your accountant involved on the front end of any capital raise is you want to describe to your accountant not only what your plans are immediately, but in the future, right? If you tell your accountant, hey, I'm starting a QSR concept and I'm opening 3 locations this year, or I'm aspiring to, that's going to be a very different valuation than if you're just saying, hey, I'm opening 1 and then we're going to wait and see. Some of that has to do with the immediacy of the opportunities, right? But it is hard to project future company value. When you're valuing it for investors, there are a number of factors that go into that, but I wouldn't necessarily factor in future concepts into your initial valuation unless you have a really crystallized and concrete plan for that growth. You don't want to raise money for 10 concepts and then wind up with 1 concept. You're going to wind up with some pissed off investors who might ask, hey, did you say that to bait and switch us, or did you genuinely have a plan? Right. So try to think about what your immediate plans are. Think 12 months out. Generally don't think too much further than that.
Here's a question from Anthony. At what point in the process do you suggest looking for legal advice?
As you know, I want to say as early as possible. I think the professionals you want in your corner initially, your accountant, your broker, and your lawyer. Particularly if you have a location in mind, right, that you're thinking about, hey, this might be a good lease for me. It kind of starts there. You want to pick a location first, because that's going to inform your budget. Your budget's going to inform your equity investment sheet. That's going to inform everything else. But sometimes helpful to engage us or to engage whoever's doing your lease or liquor license to scrub that location before you get too far along, to make sure it's eligible to operate in the way that you want it to. Seen a lot of clients say, all right, this is premature for lawyers, but then they spend all this time and invest all this emotional energy in one location, and they build a whole deck, a whole budget around that one location, and then realize when they get to the lawyers, oh, it's not zoned properly. Oh, they don't have a C of O that works. And they have to start all over again. So get lawyers involved early enough that you have confidence that the space you're looking for is right. And then, usually lawyers can operate at whatever pace you'd like from there.
A lot of questions rolling in. How often, if ever, do investors get asked or agree to be part of the good guy guarantee underlying a lease? And would you see that in a term sheet?
You would see good guy guarantees in a lease term sheet. You wouldn't typically see that in an equity investment term sheet, because it's not a term investors need to worry about. I would say if I was an investor investing in a New York City concept, I would assume there was a personal guarantee on the lease, and I would assume that the managing member or managing members, we're personally guaranteeing it.
But not me, the investor. The only
No,
time you ever
investors
see that
very,
is
very
if-
rarely personal guarantee the lease. In fact, it gets a little tricky when they do. Because they're going to expect better rights relative to other investors who don't, and of course they should, right?
The
So
only time we really see that is if it's a family member and they know that without their personal guarantee, you're not going to be able to sign a lease. But a typical investor is not going near a personal guarantee. Another question for you. With setting up an equity fund to fund concepts, growth, and scale, can you set up an equity fund? Again, question.
Generally, no. You don't want to set up an investment vehicle. What you can do is you can set up your company as a holding company, right? To say that any location of this brand is going to be set up underneath it, so that when you're raising money at the brand level as opposed to the location level. That is possible, but that assumes that when you're bringing on investors, they're going to own the IP, right? They're going to own that brand. So whether or not you want to segregate ownership across your various locations, then you probably want to just bring people into the operating location and that's it. But if you want to create an umbrella brand and bring people in on a brand level, we can talk about holding companies.
So a lot of questions here, Andrew. You ready for the next one?
Let's go.
Should you have a term sheet and or operating agreement before pitching investors? Is a deck and business plan enough to pitch? I'll answer this one. A deck and a business plan is not enough to pitch, in my opinion, because raising money is all about momentum. As soon as you start pitching and you start getting people to say, yes, we want to start taking their money. And once you start taking their money, the first person's money, raising the second person's money is so much easier because I've got some money in the bank already. People are coming in. And now you're starting to create a little bit of a frenzy, which is what you want. So if you hand someone a business plan and they say, I'm interested, and then you got to come back a week later with a term sheet, you've lost momentum. The same with the operating agreement. If you feel confident that you're going to raise the money, get your term sheet and your operating agreement together, because if they look at the term sheet and they like them, they're going to ask for the investor docs, and you don't want to wait a week for those. You want everything ready. It shows that you've got your shit together.
Yep. Another point there on the deck is whatever lawyer you're using for the corporate docs, you want to make sure that they put eyes on the deck, because it's very easy on the deck to just talk about things loosely, but to set investor expectations that will later be contradicted by the term sheet, right? So it's important that the term sheet you're preparing and the deck speak to one another. We often see decks that, it's all innocent for the most part, right? You're saying, oh, we're going to definitely do X, Y, and Z, or talking about future growth, or we're talking about voting. And then we have a conversation on the legal side and say, actually, we want to scale that back. Sometimes our ability to do that is prejudiced by what investors have already seen. So you want to make sure that if you're showing actual materials, written materials to investors, that they've been screened and that they're all part of a global plan when it comes to company structure. So that we're not accused of then of retrading right on investor terms later.
Got another question from Britt. REIP, can you confirm, if you are offering investment into the holdco, are you able to, or how are you able to carve out the IP? Is it best to address that up front in your deck or in the term sheet?
Yes. If you're carving out IP and you're saying you're coming in at a holdco, but the IP is not owned by the company, has to be disclosed. That's rare. Usually when you have a holding company, the point of the holding company is to sit on top of everything that's branded, right? If you're just bringing people in on a location basis, you don't bring them into the holding company for the most part. So it depends on what your goals are. But again, disclosure is king there. If you bring somebody into the holdco, if I'm an investor, I'm assuming any branded location is going to fall under that. Yeah. So you want to be careful with holdcos there, because the near existence of a holdco implies that you're bringing people in at the brand level. You might have an IP holding company where all the trademarks and the valuables are stored, but if you have a holding company, usually it sits below the holding company, right? So the IP is here and it sits there.
Another question from Stephen. Do you see closings done on fundraising prior to securing a location so that the operator is dealing with realtors from a credible funded position?
Usually they're happening at the same time. In certain industries, when you're doing capital financing, there's one closing, right? You're getting all the money at the same time. It's very hard in hospitality to do that because the odds of you having every cent of your raise collected all in time to sign a lease and pay a security deposit, very low. So most of the time we do raises on a rolling basis, and we're disclosing, again, disclosure is key, to investors up front that they're investing before we can guarantee the full amount of this raise is collected. Sometimes we're saying we're not going to spend the money until X amount has been collected. That can be dangerous though, because if you really have an opportunity in hospitality, you got to move quickly. We've seen situations where our clients agree to an escrow framework and they're 10K shy of the money that they need to release from escrow, and then 3 lease opportunities come and go in that time. So from an investor standpoint, they either need to get comfortable with the idea that you're going to spend money as they receive it, or they can just wait to fund until they know you have a certain amount and they feel a little more comfortable.
We'd like you to have
this
some
was
money.
One closing, every investment at its own rate.
Sorry, Andrew. We like you to have the money in the bank when you're shopping spaces. I mean, you might see 3 spaces on Tuesday and then on Wednesday, only one of them is left. So you're not going back to your investors and saying, I'm raising money and here is my location. You're selling them based on your concept, and your concept can fit into various locations. Question from Neville. Hi, Neville. Paying oneself a management fee, is that a predetermined item, or does the absence of that in an operating agreement mean that it's possible and implied?
Depends on what your operating agreement says. I can't answer that in a vacuum. If your operating agreement says, managing member is in control of everything, that's not something investors can veto, then yeah, you can pay yourself a guaranteed management fee. But again, you want to look at what you've told investors before. If you've told investors, I'm paying myself solely through distributions, you don't want to do that. You want to make sure that when you pay yourself a management fee, it aligns with the terms of your OA.
Here are some investor questions from Massimo. What ROI do people expect after break even, at least based on projections? 15 to 25% ROI per year?
Really here, what ROI, it depends. 15 to 20% ROI a year is high. I don't know that would really be the expectation necessarily. And it also depends on what the goal of the business is. Sometimes, investors invest in a concept that's going to expand and the profit just goes to that expansion. Maybe the goal is, hey, you're going to get a big lump sum payout when we open 20 locations and then we sell our brand or we start franchising it. Really depends on your business plan. That's why part of why it's so important to speak with your accountant is not only so that they can advise you on things like this, but you can advise them on what investors should expect. Because whether investors should expect 15, 20 or 0 ROI year over year really depends on what your growth plan is for them.
Right. And is build out time usually included in the projected time to break even, or does the clock start the day of opening?
Usually it starts the day of opening. You do want to project how long build out's going to take, right? All of this is our disclosures that investors are going to usually seek to know. But usually when we talk about recoupment in 3 to 5 years, the clock for that projection starts at opening.
What's a standard finder's fee for someone who raises money for you?
Ooh, big red flag there. You generally don't want to use brokers, right? And if you use brokers, if you use finders, if you pay somebody a finder's fee, that assumes that they are a registered broker dealer with FINRA, right? We want to be really careful using third parties to solicit investors for you, because if they're not registered.
What if it's an investor? What if it's one of your investors who's also finding other money for you? Nothing.
Nope. They can do that. You can't compensate them directly for doing that, because then they qualify as a broker, and that's a whole federal registration and compliance process.
Okay. Nicolina says, can you speak more to an SBA loan asking for collateral at the last minute? I was trying to apply for 7A and I'm having issues already with follow-up after I submitted everything I needed to. Yes, I can speak more to it. In order to be enrolled in the SBA loan program, banks have to submit a certain amount of applications, and they will do whatever they need to do that. So they will promise you things that they can't deliver because they get credit for putting in the application. So the reason why you're having issues is A, banks don't like to lend to restaurants or any kind of hospitality. And B, you probably, or you may not have the kind of collateral they need. So they're holding off on telling you that because that's going to end the process. So again, SBA loans, good luck, is all I'll say. What about all of the government money? Mayor Adams announced a $75 million opportunity fund to help small businesses. How do we actually get this help? Is it just tons of paperwork and red tape? I have told people about this. You can apply online. I have yet to hear anyone who has gotten one. Doesn't mean you can't, but if you go on to, I think, New York City Small Business Administration Services, whatever it is, SBS, I think they have something there. Can you provide advice about how to raise when you don't have a space yet? It's chicken and egg getting a space and raising. We talked about that. It's not easy, but you got to raise the money before you find the space, because if you find the space first, it's going to be gone by the time you raise the money. Unless you have one really wealthy investor who's just sitting around waiting for you to find a space. Mm-hmm. Last question. What if your third-party broker is an investment bank? What are flags to look out for here?
I mean, you know, you can assume the investment bank is registered to do that. For using a third party, the red flags are, who are they bringing in, right? Remember, to qualify as a friends and family raise, you generally want to have direct and personal relationships with your investors. If you're bringing in third-party strangers who are being brokered by institutional banks, a couple things. One, we're probably not as safe in relying on the friends and family exemption, and there's going to be a different process to that capital raise, that it'll involve state and federal filings. And the risk is, you know, they're bringing in people who don't know hospitality, right? A lot of investors who primarily spend time in tech or pharma are going to have expectations that don't make sense here. So you want to make sure, if they're brokering relationships for you, you have an opportunity to kind of screen and vet those people and talk to them personally and directly, make sure the expectations are aligned. It's very rare that banks get involved to kind of broker these kinds of deals, but it's certainly something worth exploring. Just know that it does add some more regulatory hurdles to clear.
Well, Andrew, I think that about wraps it up. Thank you, as always, for putting together a fantastic webinar.
Of course, thanks everybody.
Incredibly knowledgeable. And thank you all for coming. I love having everybody here. We always have a big turnout. We ask lots of great questions. I'll leave you with this. If you haven't started a hospitality group yet, you should talk to us about that. The days of opening up 1 or 2 restaurants and then coasting are over. And we are opening up hospitality groups left and right, and we can set you up nicely. But it is the key to success in this industry, I think, moving forward. Thank you all for coming. It's been great, and we will see you very soon. Stop by the office sometime too. Bye-bye.
Thanks, everyone.